Hey everybody, Signet here from the Bullish Bears. And today I want to do a little introduction to straddles and strangles and maybe a little of the misconceptions that go with this trade strategy. So what you're looking at here on the risk profile is a long straddle. This is where we buy a call and we buy a put in the same expiration with the same strikes. And you can see the price of this thing is $8.48. That's $848. Now, what you need out of the market when you get into a trade like this is you need the market to move drastically in one direction or another. When we talk about drastic, my views might be different than your views on what we each consider drastic. So what we can do is we can set these slices here in the risk profile for a move around 2%. And so if we do that, you can see now that each of these yellow lines is a 2% move. Now for this trade to be profitable at or near expiration, we would need price to move from its current location, which is right here at 182.5, all the way out to here past 190.5. All right, and that's over a 4% move in the market. It's the same thing to the downside. If each one of these lines represents a 2% move, we would need to go beyond 4% before expiration to be profitable in this trade. So as you can see, that's a very big move that we would need out of the marketplace in a straddle to go long. All right, now what is this trade? We want to take advantage of large stock movements in either direction. And if you anticipate an upward move in the implied volatility, right? So if you're expecting a spike in implied volatility and you're expecting a large move out of the market, this would be a really great trade to use. Recognize that at earnings, you don't get a large spike in volatility. You get vol crushed, right? Volatility gets crushed out of the marketplace at earnings. So using a long straddle for earnings is a bad idea because you're not stacking the odds in your favor. You're going to lose money while you get vol crushed, even if you do get the explosive move in the market that you're looking for, right? So this isn't the appropriate trade to use in that environment. The other side of the long straddle is the short straddle. Now, as you can see in this one, we need the absolute opposite. We don't want the market to move anywhere, but we also can tolerate a 4% move to the downside or a 4% move to the upside, and we could still find profit in this trade. Granted, not very much, right? But we wouldn't be at a loss. Now, if you're new to risk graphs, this red line would be your profit or loss at expiration. And that's a very key point to recognize, that a lot of times for you to hold an option into expiration would cause you to be assigned, depending on the type of trade that you have. So often when these risk profiles are looked at, newer traders don't recognize that they have no chance of ever getting this line because they wouldn't be able to hold those options into expiration. They would be assigned, and that is something that we typically avoid. This is the type of trade that we would want to use when we do not expect a move in the market. And again, this is a very expensive trade. You would collect this $848 of credit, but the buying power required to put on a straddle or a strangle is extensive, and that's why it is prohibitive to small accounts, right? People with small accounts really just can't trade the straddle and the strangle. That needs to really be recognized. This is a large account trade strategy. So normally around the time when you won't have expected news, right? So this is another one that you wouldn't want to do near earnings because you don't want the market to move, and a market can and often does move around an earnings event. And if implied volatility gets crushed, this would be a good trade to hang on to. You would see profits in your trade if you get vol crushed, right? So if you did participate in this trade at earnings when you were anticipating no price movement and you were anticipating a vol crush, this could pay out very quickly. You could hit your target profits because this green line, which represents what your actual profit is in the trade, it would begin to spike up and form the shape of this red line if volatility was to get crushed out of this trade, right? So straddles are not just a trade that we put on when we're looking at price. We're not trying to hit a dartboard of only landing right in the center or only staying right in the center. It's also a trade that we would look at depending on the type of volatility that's in the marketplace. A lot of the options trades that we do put on, we don't require or even look to see a move in the market. Oftentimes, the options trades that we place are strictly implied volatility trades or perhaps even just time decay trades. We don't need price to move in a lot of our options trades, and this is one of them. So what we also have is a strangle. So let's look at the long strangle. So as you can see here, and I didn't make it very wide, so perhaps I'll widen it out a little bit to make it easier to see. We'll add another dollar and flatten that out. And then we'll let's just make it a lot wider. How about that? How about that? All right, so we got it nice and wide here. So as you can see, the wider I got it, the cheaper it went. This trade, again, needs a very large move out of the marketplace to be profitable. The difference between the straddle and the strangle is the straddle used both strikes of the same type. So the call and the put were both using the 82, whether I went long or short. But the strangle did the exact same thing. We did a call and a put, but we have different strikes. So we're buying a call and we're buying a put, but they're differences. And the differences end up being where our break evens are at, right? So we now have the 185, the 180, and that's where you can see, not the break evens, I misspoke. That's where you can see the valley in this trade, right? So when would we use a long strangle? This takes advantage of large stock movements, like I spoke, and if you anticipate an upward implied volatility. So if you're looking at a market event that might cause an explosion in implied volatility, this would be the type of trade that you would look to put on. Now remember, when price rises, typically volatility falls, and when price falls, typically volatility rises. So you wouldn't necessarily need a move in price to see that volatility spike. Oftentimes we can see volatility spike in the market because of some outside external source like Brexit. Brexit caused a spike in implied volatility, and that would certainly make this trade profitable without actually seeing a move in the market at all. We have the short side of the strangle as well, and I'll widen that out $5 to make it easier to see as well. It's nice to distinguish that flat valley area, or in this case, that flat peak. Right now, what do we need in a market like this? Is we need a volatility crush and or price not to move anywhere. Right now, you do have quite a wide tent, what they call the butter zone. So price could move quite a ways, and yet you could definitely remain profitable, um, especially if that implied volatility was to get crushed out of the marketplace. This is another one of those trades where it could be profitable at earnings if price did stay within your boundaries and you took that volatility crush. When we play volatility trades, earnings are really an opportunity to repeat history. When you go and you look at the charts, you can bring up the indicator showing implied volatility, and you can look at previous earnings announcements to see how hard the volatility got crushed out of a market. And then you can anticipate that trade pattern and perhaps place a short strangle trade. So this video was just to introduce you to the idea and the concepts of the straddle and the strangle, to help you recognize that it is a large account trade strategy, and that uh, it is dependent on volatility either spiking or getting crushed. So I appreciate you watching this video, and I look forward to seeing you at the next one.